Welcome to Talk Tickers. We break down earnings calls so you don't have to. Today, we're jumping into Plains All-American, that's PAA and PAGP, looking at their first quarter for 2025.
Yeah, it was a pretty solid quarter overall.
Right. So the big number, adjusted EBITDA, attributable to Plains, came in at $754 million.
That's the one. And breaking that down a bit, the crude oil segment, that was $559 million.
Okay, but wasn't that impacted by the weather and some refinery issues early on?
It was, yeah. Winter weather hit them, plus some refinery downtime. But they did say things picked up quite a bit in April and May. Nice recovery there.
Good to hear. And the NGL side?
NGL has brought in $189 million adjusted EBITDA. They actually benefited from better frac spreads and, interestingly, stronger sales volumes because of increased flows across the border.
Okay. And looking forward, are they changing their tune on the year's outlook?
Not really, no. They've reaffirmed their key assumptions, still looking at, around $75 a barrel for WTI on average. And they're sticking with that 200,000 to 300,000 barrel per day Permian growth number for the year.
Gotcha. And free cash flow, that's always a big one.
Yep. Adjusted free cash flow for the year, they're projecting about $1.1 billion. Now, keep in mind, that's before changes in assets and liabilities, and it's reduced by about $635 million they spent on acquisitions.
Okay, so a stable picture, but definitely some moving parts. Let's dig into that market environment they're facing. What did they highlight?
Well, the big thing is still uncertainty. Trade tariffs, specifically, are making economic forecasts kind of volatile.
Right. That's been a recurring theme.
Exactly. And then there's OPEC, some dissension internally, potential for maybe more supply hitting the market. That's part of why commodity prices have been a bit lower than maybe folks expected earlier.
Interesting. But Plains seems to see a silver lining there.
Yeah, kind of a counterintuitive take. They actually think this lower price environment, while maybe tough short term, could lead to a more constructive medium to long term picture. It reinforces that cyclical nature. Prices go down, supply reacts, eventually setting up for the next upswing.
So playing the long game. But what if, hypothetically, prices stay lower, say in that $60-$55 WTI range? What happens to their 2025 numbers?
That's a key question they addressed. If that scenario plays out, they said their full-year EBITDA guidance and that Permian growth forecast would likely end up toward the lower end of their ranges.
Okay, so there's definitely sensitivity there.
Oh, absolutely. It shows how much those commodity prices matter to the bottom line, even for a midstream company.
Makes sense. Now, you mentioned the NGL segment earlier. It sounds like it's maybe a bit more insulated from these price swings.
That's right. It's relatively well protected, and the main reason is hedging. They've hedged about 80% of their estimated C3 plus spec product sales for 2025.
So locking in prices, basically.
Exactly. It reduces their exposure if prices suddenly drop. So even if crude or NGL prices weaken generally, a big chunk of that NGL segment's revenue stream is already secured.
Okay, let's shift gears a bit to growth. How are they approaching that? They've been making some acquisitions, right?
Yeah, their strategy revolves around what they call efficient growth. The goal is pretty straightforward. Generate strong free cash flow, keep the balance sheet healthy, they mentioned, targeting the low end of their leverage ratio range, and, importantly, return capital to unit holders. Their main way of doing that is through distribution growth.
And the acquisitions fit into that, like Cheyenne and Black Knight.
Precisely. Those are classic bolt-on acquisitions.
Can you just quickly explain what bolt-on means for listeners who might not be familiar?
Sure. Think of it like adding a complementary piece to your existing puzzle. It's usually a smaller acquisition, something that fits geographically or operationally really well with what they already own. So the Cheyenne pipeline, they bought the other 50%. It connects well with other pipelines they have stakes in. Black Knight is a crude gathering system right in their Midland Basin footprint.
So it adds value without being this massive, transformative, potentially risky deal.
Exactly. It enhances what they already have, off-brings synergies. They've actually put about $1.3 billion into these kinds of deals over the last few years, seeing them as, attractive risk-adjusted ways to grow.
And you said distribution growth is the priority for returning cash. Why that over, say, buybacks?
Well, for many investors in this space, those regular growing distributions are a huge part of the appeal. It signals confidence in future cash flows. They view unit repurchases or buybacks as more opportunistic, something to consider if the market gets dislocated and their units look really cheap. But the primary focus is that distribution.
Makes sense. What about the broader M&A scene? Do they see more deals happening?
They acknowledge that market volatility can sometimes make M&A trickier, more questions pop up. But their view is that good deals just take time, regardless of the environment. And given their position in the value chain, they feel like they're well placed and see a decent supply of potential opportunities out there.
But they're being picky.
Very much so. Capital discipline is key. They stress taking a hard look at the risk-adjusted returns before pulling the trigger on anything.
Okay. Let's talk about a specific project, the Canada fractionation expansion. That's up and running now.
It is. The Fort Saskatchewan facility expansion, adding that 30,000 barrels per day of fractionation capacity, came online in the second quarter.
And what's the impact? Are we seeing it in the numbers yet?
Not fully yet. New commercial contracts are kicking in, and they expect volumes to ramp up through the rest of 2025 and into 2026. It's part of a bigger picture, too. They've got other connectivity and gathering projects along the NGL chain coming online this year. The full sort of run rate financial contribution, though, they're really expecting that in 2026.
Got it. And that Black Knight midstream deal, can we zoom in on that one a bit more? What was the strategic rationale there?
Sure. It's in the northern Midland Basin, a key area. And interestingly, Plains was actually already operating that system for the producer, so they know it inside and out.
Ah, okay. So buying it makes sense from an efficiency standpoint.
Exactly. Long-term capital synergies, better connectivity to their other assets in the region. Plus, the producer involved is considered top tier with really good acreage. Plains basically framed it as a win-win, good for them and good for the private equity partner who developed the asset initially.
Okay, let's talk Permian. Always critical for Plains. What's the latest on production growth there? Still bullish?
Well, they pointed out that quite a bit of growth has already happened this year, over 100,000 barrels a day since the end of last year. But yeah, the recent price drop has made producers a bit hesitant. The sentiment was described as wait and see. Companies don't typically rip up their 2 or 3 year plans based on 1 month of price action.
So the guidance holds for now, that 200K to 300K barrel per day growth for 2025.
Yes, they're sticking with that exit-to-exit guidance for 2025. But they did give some important sensitivity.
Which was?
If prices stay below $55 UTI for a sustained period, you could see production flatten out or even decline. If they stay consistently above $65, that could spark growth again.
And in the immediate near term, next few months?
At current prices, they don't expect big changes in activity. But if low prices drag on longer, then yeah, you might start seeing completions deferred, maybe some rigs dropped. They really emphasize that the bigger catalysts for volatility and the longer-term view are things like those trade tariffs and whatever OPEC decides to do.
When they do these bolt-on deals like Cheyenne or Black Knight, are they getting good prices? What kind of multiples or returns are they hitting?
They were pretty clear that the recent deals met or beat their internal return thresholds. The Cheyenne deal was interesting. It wasn't a straight cash purchase entirely. It involved reducing future minimum volume commitments or MBC's payments they'd have to make anyway in exchange for taking full ownership. The return was baked into that structure.
And Black Knight?
For Black Knight, the aim is to get a solid base return. And they mentioned only allocating limited to potential synergies initially. That suggests they see upside to potentially compress that multiple further as they integrate it and find more efficiencies.
What about overall capital spending? With these acquisitions and projects, is the budget changing?
Nope. 2025 investment capital guidance is unchanged. Still $400 million net to Plains.
Good.
The big Fort Saskatchewan expansion piece is done, so the ongoing spending is more on related NGL supply projects, connectivity, and then, of course, the Permian. That Permian capital, things like connections and gathering, it's designed to kind of follow the producer's pace. They typically plan that work 6 to 12 months out.
And looking ahead to 2026, any early hints on spending levels?
They expect 2026 capital spend to be within their sort of standing long-term guidance range, which is $300 to $400 million net to Plains. So pretty consistent.
Let's talk hedging again briefly. What's the overall philosophy there? Is it just about smoothing things out?
It's pretty consistent, really, driven by their fundamental market view. And yes, absolutely, the need for steady, predictable cash flow. They take an opportunistic approach within that framework, setting targets. And recently, because the market's been backwardated, front month prices higher than future prices, they've been hedging more on the near-term part of the curve. That's similar to what they've done in recent years.
How much does the Permian specifically drive things versus, say, global oil dynamics?
Well, they describe the Permian right now as a supply push market. Basically, the price for that marginal barrel coming out of the Permian is really set by what the end consumer, the refiner, is willing to pay. And that sensitivity they gave, the 65 WTI impacting production, that's for the full year 2025 Permian outlook. So it highlights just how significant that basin is to their overall results.
Okay. And on the NGL side, you mentioned spec sales. Is there seasonality people should be aware of?
Yes, definitely. Butane and propane sales, the spec products, they do have seasonality, mostly tied to winter, right? Colder months mean more demand for propane for heating.
Yeah.
To manage that, they use about 8 million barrels of storage. It lets them kind of optimize when they sell based on market conditions rather than just selling ratably. Condensate, though, that tends to sell more steadily through the year.
Got it. They mentioned volumes bouncing back in April and May after that weak Q1 start. What drove that recovery specifically? Was it price related?
Mostly operational recovery, actually. Production coming back online after the January-February weather disruptions. And also just the normal spring uptick in well completions that might have been deferred over winter. They specifically said they haven't really seen a significant impact from the more recent price volatility yet on those volumes.
Interesting.
Yeah, and they noted that in Q1, it was more the lower margin, kind of local intrabasin volumes that took the hit. The long-haul volumes were more driven by downstream demand. So looking ahead, they expect those long-haul numbers to pick up more with summer driving season kicking in and refineries running harder, needing more crude.
And stepping back again, the really long-term Permian view, has anything fundamentally changed there for Plains?
Based on their comments, no. Their core long-term expectations for Permian growth and how utilized their pipelines will be haven't really shifted materially. Pipeline use is, at the end of the day, a function of production volumes. But again, they circled back to those external factors, tariffs, OPEC decisions being really key for the broader, longer-term outlook.
Did they offer any signals from the demand side? What are refiners and the export market telling them?
Yeah, they said global refining markets look pretty healthy right now. Good crack spreads, that's the refiner profit margin. As refineries finish turnarounds and ramp-up runs, those lower Q1 refinery deliveries are definitely picking up.
And exports?
Exports can be a bit more choppy, month to month, even week to week. They noted some recent slowdown, but the underlying view is that the barrels will move, they'll find a home, and they'll get priced accordingly. Healthy global refining margins generally point to continued demand.
Okay, last major topic, leverage. How are they managing debt? Are they trying to drive it super low?
They seem comfortable where they are, operating within their target leverage range. They actually view having that capacity as a strategic tool, allowing them to make those quality investments when opportunities arise.
So no target to hug the bottom end of the range forever?
Doesn't sound like it. The priority is maintaining their investment-grade credit ratings. They want to keep those BBB ratings from all three agencies. So they'll manage leverage carefully to make sure those ratings aren't jeopardized, but they're not necessarily aiming to be at the absolute floor constantly.
All right, that covers the core results and strategy. Let's shift to our "this is not financial advice" segment. Time to cook up a speculative trade idea based on all this.
Okay, let's brainstorm. So Plains is heavily invested in the Permian. Management seems to think the current production slowdown is just a temporary blip caused by price volatility.
Right.
So here's a thought, purely speculative, of course. What about going long? Plains All-American units, PAA, but at the same time, maybe buying some short-term put options on a major Permian-focused E&P company.
Okay. Long PAA, short a producer via puts. Unpack the logic there.
Well, the long PAA position is a bet that Plains management is right. Oil prices stabilize or tick up, Permian growth gets back on track, and Plains benefits from higher volumes on its pipes, supporting distribution growth. That's the core thesis.
Okay, makes sense. And the puts?
The puts are kind of a hedge, specifically against the near-term risk. If oil prices do stay stubbornly low for the next, say, few months, a pure play producer might feel that pain more immediately and acutely in their stock price than Plains, which has more contracted revenue. The short-dated puts could potentially offset some losses on the PAA position if that near-term low-price scenario unfolds.
So it's kind of a bet on midstream resilience relative to upstream sensitivity in the very short term, while still positioning for the longer-term Permian recovery.
Exactly. Trying to play both angles. Acknowledging the immediate price risk impacting producers, while betting on the fundamental value and eventual volume recovery for the midstream infrastructure provider. It's definitely more complex than a simple long or short.
Absolutely. And we have to stress again, this is just a thought experiment, not investment advice, not a recommendation. Please, everyone, do your own homework. Understand the significant risks involved in energy stocks and options before ever considering a trade.
Couldn't agree more. This is a volatile sector. Any decisions need careful thought about your own financial situation and risk tolerance.
Okay, that wraps up our deep dive on the Plains All-American Q1 2025 earnings call. We've hit the results, the strategy, the market factors, hopefully giving you some useful takeaways.
Yeah, lots to digest there.
The energy world never stands still, does it? So keep learning, keep asking questions. What's your take on Plains strategy? See any big tailwinds or headwinds we didn't cover? We'd love to hear your thoughts. Until the next time we dig into a ticker, this is Talk Tickers.